their yield is maybe just north of 5 or maybe 6. When I'm wondering whether these interest rate hikes are gonna crush REITs. Yeah.
Mr. Maximus is not here.
Yeah.
I don't know. This one I didn't follow REITs so much, right? But let's say if we just apply the same concept for all sorts of assets, right? You can also say that now interest rate is higher, but right, all properties should drop, right? But if you look at the property market, at least in Singapore, it looks like it's still doing well, very, very well. So I'm not sure whether all this theory that interest rate hike should lead to property crashes, REIT crashes, stock crashes, whether how true it is also, I think there's no clear evidence, at least till now. We don't know what will happen in the next 3 months, 6 months, 12 months, right?
Yeah, correct. Because, I'm thinking, what constitutes inflation? I was thinking, don't rents also, constitute inflation? So, yeah, I was wondering whether are rents going to go up? Hence, it mitigates the interest rate hikes, that kind of thing. Yeah, just wondering a lot.
Yeah, that's true. But I think for REITs, right, because I also have some conversation with friends that are investing in REITs, I think their comments is this, right? For those who are at least bullish on the sector, right, they'll say that it's not always the interest component, right? Yes, REITs, if you look at their balance sheet, it's made out of their assets, which is all the investment holding. Then on the liability side is all their debt, right? I think that might be, depending on which REITs that we are talking about, some are like 30%, some are like higher, 40% funded by raising, by taking on debt, right? But all this debt, they are not like short-term debt. So when we talk about like interest rate hike, these are like, overnight rate, right? Whereas for REITs, when they borrow, they can borrow, like short one could be 3 years, long one could be 5, 10 years, maybe some even longer, right? So now if you look at rate hikes, let's say like the overnight rate or the 1 year rate is already quite high. But if you look at the 5, 10 year rates, right, it's higher, but not as high or not as crazy as the short rate. So what happens is that, yes, it will increase their borrowing costs, but it's not like rate hike 75 basis points, then the 10-year rate will hike by 75 basis points, right? It will be smaller magnitude. So I think the concern is more like how, like this rate hike cycle, how long will it continue? Like, is it like 75 basis point, then followed by another 75, followed by another 75? You pump the short rate until 5, 6, 7%. I mean, that's the worst scenario, right? Then the 10-year rates, for sure, it won't keep at, let's say, 3.5%, right? It could be at 5%. So that one will have a serious impact because it will immediately hit the DPU for the REITs, right? They will have to refinance. Yeah, it's not like they have to refinance immediately because their bond is somewhat longer, right? But after 1 year, 2 years, 3 years, they have to refinance, right? And if they refinance at, let's say, 4% cost of debt versus 5 versus 6%, it will be a lot different, right? So all this will hurt into their DPU now. Yeah, but at least for now, I think that's the one side, right, which is the cost of financing. Then the other side, which is the rental, right? So I don't know. I think, I mean, for those who are like, if you go to malls, you can see that now actually the crowds all come back already. It's really packed everywhere, right? So you can feel that, right? So at least on the business end, I think they are still doing okay. So they will be able to pay all this rent, right? And even the REITs, they can, I mean, the managers, they can even increase the rental, right? So this one will cushion a bit. So let's say if you can do some simple maths, right? For example, like let's say just 1/3 of the REITs, right? They are financed by debt. Then the assets, the rental side, let's say they just only increase the rental by 1%, right? That's enough to cushion like a 3% increase in the cost of funding on the debt, because the asset to debt ratio is not 1-to-1. It's like, let's say 1/3, right? So there's a bit of cushions there now. So that's why I said sometimes, although all these narratives sounds very convincing, cost of financing increase, DPU for sure will drop one. But when you look at the rental side, if rental, they keep on increasing the rent and then it's still doing fine. And then their asset to debt ratio is like the debt, how to say it, the debt to asset ratio is low, then I think they are fine, right? So
have you guys
I think
considered buying debt rather than buying the REIT itself? Because I've been investigating ESR REIT, which is the largest APAC one, and debt is about 5 to 6%. So if I had a choice between buying the REIT or the debt itself, I think I would buy the debt right now.
yeah, a lot of different consideration when you talk about this, because ultimately these are two different, you know, the claims, right, is different priority. So if you invest in debt, if you are like 100% sure that, okay, given their capital structure, they are fine, right? Then I would say 5-6% for the debt is quite attractive, because you will be cushioned by the equities, right? But I don't know about ESR specifically, but some REITs, right? If their assets, if their holdings is questionable, when a serious crisis hit, right, then the debt, sometimes it will hit into the debt as well, right? So I think that's the things that you need to pay attention to. But so I think for debt, just to summarize, right, for debt, if you have high confidence that they will be able to fulfill their obligations, then they should be quite attractive. The question is always like, okay, what if a serious crisis hit and then they are not able to service their debt, meaning that the debt will be downgraded and so on, they might default, right? Then investing in the equity and debt structure, you will still suffer a huge losses, right? So that's the only thing to consider now. But I will agree with you, 5-6% for the debt, I think it looks quite attractive there. Given that your DPU for the equities, like let's say it is not much higher than 5-6%, right? But let's say if you buy the REITs, it can give you like even more, right? 8-10% dividend yield. Then always there's the trade-off between risk versus the return versus risk, right? So I can't comment that much because I haven't looked at this ESR specifically. Then you also can look at the debt, what kind of ratings that they are getting, right? If it is like BBB or lower, right, then need to be careful. There's a reason why they're getting a BBB or BB kind of rating, right? Yeah.
Thanks for your input.
I saw there's quite a number of you guys here. So do you guys have any topics that you just want to, like, before we go into, like, the Q&A, or because I prepared some materials also, but I just want to ask you guys, like, let's say like the REITs questions. I think that's a very good questions, right? Is there any other questions that you guys want to like bounce some ideas to talk about? We can start with that first. Then we prioritize these ones first. Any topics that you guys want to discuss? You can just throw out some topics, like if you have specific questions.
Okay. Actually, yeah. Okay. I was looking at the CPI data lah. Okay. So year on year, yeah, it looks very bad. Wow, 8+%. But I mean, when I look at the month on month, right? Actually, how to say, isn't it okay already? Like the fire is not going out of control. Month on month, it is almost zero. I think, was it zero? Month on month was what, 0.1, is it? 0.1, right?
I don't have the numbers here.
Yeah, if I remember correctly, it's 0.1 for headline.
Yeah, so it was 0.0 last month, 0.1 this month. If we complete 0 all the way to the end of the year, you'll be roughly, the year on year will be roughly about 4%. But the question is whether or not you grow the rest of the year.
Yeah, correct. So I'm wondering, do they need to be so kanchiong, or 0.75? Yeah, especially this pet who, they don't really seem to be, what's that word? Hawkish, yeah.
Just a bit of historical context. Whenever the inflation rates go up, and then it comes down again, usually month on month can go negative. This time around, it's not going negative, it's going 0. So it's either going to be 0 for a long period of time, which means a very, very slow recovery, or it's not going to be similar. because similar last time it was negative. It was negative 10% in 2008 or something like that for one period of time, just a single month.
Yeah, let me explain a bit why there's a bit like panic after the data was released, right? So I think the first point I want to say is that when you look at month on month, right, this is really like you're comparing 1 month versus 1 month, meaning that even if it is just 1%, right, if it increased by 1% in a month, right, you just annualize it, it becomes like 12% a year. That's why even like you look at the number, it's like 0 point something. The number itself looks very small, but you need to remember it's monthly comparison, right? So 1% is equivalent to almost like 12%, or even if 0.5%, right, that is translated to like translated to 6%. So for the month on month, you really want it to be like very low. It shouldn't be more than like, let's say 0.2%, because even 0.2 will, if you just times 12, it will be like around 2.4%, right? So that's first reason why, even though it's just like mildly positive, why people panic. Then the second reason, right, is that if you look at the why people panic about it is because before the data was released, actually I think there's a lot of forecasts that say the headline inflation should be coming down, right? But then the headline inflation should come down because you can see that the oil price already dropped. So because oil price is made out of like huge huge proportion of the entire inflation numbers, right? If you look at the oil price has dropped, so you expect the inflation to drop, but yet it didn't drop as much. So it is a bit like the actual versus expectations that is off now. So it is like the surprise on the upside, right? So it drops. And then the third point is that there's when they look at inflations, right, usually there are two views, right? One is we call the headline inflations, meaning that whatever, let's say all this oil will be included, right? Then the second one, which is I would say more important one, is the core inflations, meaning that they will take out all these volatile components. For I think the main one will be the crude oil now. So if you take up the oil or energy prices, right, I think that one also is kind of like surprise on the upside. What it means is that now the inflations is not so much about oil anymore or energy prices, because anything to do with energy, right, you just need to track the energy prices. Energy can shoot up very high and then it might crash down very fast also. But let's say if the inflation is not on the energy, right, like all these energy commodities, right, it affects the, let's say the general inflations, meaning that the services or the salary or the, like people just keep on pricing in more inflation in the future. Hence they jack up the price now for all goods items, right, for all kind of services, right. When this one is continue, like we see this kind of inflations, right, it will be very, very difficult to cool it down. So I think the core inflation is quite worrying, especially if you look at like month-on-month data. If it comes down, right, the core inflations come down on month, you get some negative figures, right? Then it will provide some relief, right? But we haven't seen that. That's why I mean the surprise is on the upside, right? So it means that whatever Fed has been doing since early of the year till now, right, it has been like, I don't know, like 6 to 9 months, right? They have been trying to communicating and then do some couple of rate hikes, and hence and yet we still haven't seen any like some tangible cool down in inflations, right? And at the same time, if you look at all this, I think some news in the past 1 week, all the growth has been slowing down, right? So now we are getting the economic has been slowing down, but inflation haven't. So it's like worse. I mean, both sides, right? The growth and inflation both are pointing towards the worst side. That's why, like the stock market don't like it. Yeah. So just I think these are some small, data points that people it isn't that obvious now. And always we are talking about 0 point something % of the like of the expected the forecast inflation number, right? So it looks very small, but if you look underneath the data, indeed there are some points that is a bit concerning. Yeah. Any comments or any other topics? Any other questions? If no questions, let's look at the, wow, there are quite a number of questions here. I think it's okay. But let's say if you guys have anything, just stop me. And any topics that you want to ask, we can chat about it. If not, I'll just proceed with some material that I have prepared here. So let me just give me like, I think hopefully I can cover this in 15 minutes. So just bear with me. Okay, just a quick review on the market in the past 1 week. So, okay, I think last week I mentioned, right, beginning Monday should be green, right? Okay, indeed it's green. But then after that, it's just that all this, after inflation data came out, then straight away we see this drawdown, right? So over the week, 5% drop in S&P 500. And then, of course, for QQQ, dropped even more, dropped by 6.2%. And then this week, I've been looking at the interest rate, right? So if you look at the, this is some headlines from CNBC's, right? So bond yields rise, 2-year treasury top 3.85% on higher Fed rate expectations. So this is true. If you look at the CME, I would say that looks quite high now. So we're expecting to see a 75 basis point rate hike, but it seems that we won't get the slowdown now. So probably 75 hike and then another 75 hikes in November. And I think these two meeting period is quite near. It's like for about 1.5 months. So within 1.5 months, we're going to see a 1.5% hike.
The number is a bit strange.
Usually the CME, this CME tables, right? This one you need to, I think if of the trading hours, it will be quite, sometimes it will be quite weird one. But during trading hours, you look at it, it should be back to normal. Sometimes you will jump around. So let's say if you check it now, I think sometimes it look very weird. It's normal. But you will come back to the reliable numbers during the trading hours. Like let's say during weekdays, if you check that they are fine. But this 75 plus 75, I think this is okay. Then come back to the 1 year. This is the number that I talked about, right? So you see, just like 1 year ago, not too long ago, it's like 0 point something percent, right? Then now just suddenly shoot up to 4%, and these numbers will be highly correlated with the Fed hike. So I think this one is a good forward indicator to see where the Fed fund rate is heading to. And now, yeah, the number is 4%. Then the yield curve, if you look at the yield curve, this is the 1 year rate. So 1 year rate is close to 4%, but we are seeing the the yield curve inversions, right? So the 10-year rate is about 3.5%, right? So this one, right, is always a negative kind of indicators, because when the longer is the treasury rate, you are taking more risk, right? Because let's say the yield continue to go up. If you hold a 10-year bonds, right, you will suffer more compared to a 1 year bonds, right? 1 year, they don't have much duration because anyway, 1 year later, you will get back your principal, right? So you are not taking a lot of what we call the duration risk. But the 10-year rate, you are taking more duration risk compared to 1 year. Hence, let's say under normal situations, the 10-year rate should be higher. But now we are seeing inverted, right? What it means is that people will rather lock in 3.5% for 10 years and not betting on like the 1 year rate continue to go up and up and up. Because if the 1 year rate start with 4%, it will go up and up. You just keep on buying 1 year for the next 10 years, you should get higher than 3.5%, right? So in order this one to become like makes sense, what it means is that market think that the 1 year rate in the future, in the next 10 years should be lower than 3.5%, right? So that you will average out getting back the 3.5% here. So what it means is that people are expecting the short rate to, although now it looks high, it will come down later. And it will only come down, let's say, it will only come down when the economy looks bad over the next 10 years, right? So I think this is always not a good sign. It always like a forward indicator when we look at the slope of the yield curve. But anyway, this is interesting as we see the 1 year rate is getting higher and higher. I think that's all on the macro sides. So anything you guys want to ask? If not, we go and see some of the like news, and then I'm more like pointing this out and just want to see around. Anyone want to give some opinion on these topics? So the first one is the news of Adobe buying Figma, and then their share price just crashed, right? I think crashed by what, 10, close to 20% in just single day, right? So it's a huge crash, especially for big companies, profitable companies like Adobe, right? Actually, for Adobe, just 1 year ago, even when it was trading at $500 plus, I was thinking that, okay, maybe this is the companies, companies, good companies, right? Generating a lot of free cash flow. I was thinking of buying it actually. But I think I forgot why I didn't buy it. It's just that I looked at it before. So, and just to look a little bit into the details, right? So this company, the Figma company they bought into, I think their revenue is only 400 millions, but they bought it at 20 billions, right? So this is like 50 times revenue. Although this one looks very crazy, but if you look at the Figma, their historical revenues, right? Actually, they are growing very, very fast. So if you just look at the All-In podcast this week, right? I think just released either yesterday or today. There's this chart that they pull out to shows that the revenue is kind of like triple after triple and then double again. And this 400 millions for 2022, it will go up to, I think, about 800 millions next year. So even though the price over sales looks very big, if you look at today's revenue, but as soon as this revenue double again, then I think the valuation will look much more reasonable. Yeah. But on this view, my personal view is that, sometimes that's the things, right? I think, at least for my assessment on Adobe, is that they go so desperate to spend 50 times to buy out a startup, right? Just show how desperate they are. And they will only be very desperate if their own offering isn't that good, right? So it seems like they might be like losing out, and hence they have to use the acquisitions just to reduce the risk, right? So I think that's the negative side, like assessments, like why they need to keep doing this, right? And they spend 20 billions. If you just look at their net income, right? Their yearly net income is only like, like 5 billions. And I don't know this net income, whether it's projected to grow exponentially, right? But if you just look at this number, they are basically spend like 4 times of their own earnings, right? To buy over a companies at 20 billions. And that 20 billions, I don't think Figma is already like, making money, right? And it will hurt their free cash flow after they bought over this company. But they can't afford not to buy it, because if you lead this, you don't do anything on it, then one day later when this company become big, right, they will come and eat your markets, right? So I think that's something to consider also. The good thing is that they already kill off the competitions by just acquire them. I think that's the good part, even though this might not be from a competition point of view, might not be a good thing, right? But the bad part is that, just show how desperate they are. And this might not be the end, right? So this year they're buying Figma. Who knows, next year they have to spend another, tens of billions to buy over Canva. Who knows, right? And if the company can only know how to buy over competitions, right, it doesn't show, like, it doesn't give a lot of confidence. Yeah, so that's some take from me. So I saw that there are some friends here, I think, working on the software industry. I don't know whether you are free to, give some opinions. So I'm always happy to hear, some comments from whoever who are like watching this news. Anyone want to contribute or want to comment on this news? You'll become solo show again if no one comment. Or you guys have any questions on this? If not, we will just move on, yeah? Okay, if no, I'll continue. Let me just finish up this slide. Okay, the next one is about antitrust, because I think last week video there's one comment on the YouTube. There's one friend that asked me to comment on the antitrust. I think the current antitrust, right, which is this one, what they call the American Innovation and Choice Online Act. So I think it's quite specific in terms of what's in the provisions. So I think this one, the first one is the most important one, which is the self-preferencing their own products at the expense of competitors. And then if you look at the big techs, right, I think there's quite a number of examples. Let's say like Apple's, they have their Apple Musics, Apple Music competes with Spotify, right? So, you know, they have really advantage when it comes to competitions, given that all the iPhones, right? If they sell iPhones, the Apple Music is already installed, right? So all this will it's something like a preference, right? Or even if you buy iPhone, they give you free for whatever 3 months subscriptions, right? These are also like self-preferencing. And then the most serious one will be companies like Amazon. They, you know, when they try to rank their products, they can always rank, you know, products like Amazon Basics to be on the top, right? The other companies, they have to spend on the advertising to push their product offerings to the top, right? But for this big tech, they don't have to do so, right? They can just say, okay, this is my own products. Of course, I give free advertising to my own products, right? So this is, I mean, from antitrust perspective, it's really not fair, right? So if they pass on some laws like this, right, to say, okay, from now on, you cannot do these kind of things, right? I think Google also the other one, right? They will always prefer lead you to Google Maps or lead you to like Google Maps with their product review, which compete with companies like Yelps, right? So of course, these are their so-called their mode, right? When they own the platforms, they can always kill off the competitions and just direct the traffic to their own offerings, right? So this is their strength, of course, but all this strength, if the government want to attack it, of course, it looks very bad and it will be very negative. It will affect the companies. And if this one become a law, then please expect that their share price will drop because it will hurt the business itself, right? Like directly hurt their business. If you don't believe this, you just need to look at China. You know, when China, they come up with all these different antitrust regulations, it really hurts companies like Alibaba, maybe like Tencent and Meituan, right? So this one you can take it as a learning. That's the negative part. But the positive part is that I think there's this, you know, when it comes to US versus China, the difference is that all these big tech, they are very good at, you know, lobbying. And based on the latest news, it seems that this, you know, this bills, right, will not pass soon. So all these big tech is spending big monies to make sure that antitrust regulation like this won't be passed. So they will just lobby with their legislator and then do stuff behind the scene. But it's really hard to pull off this kind of, you know, antitrust. So this is the biggest difference if you compare US versus China. For China, they just flip the switch and then it's done, right? So that's why, yeah, that's the difference. So I think just to close this one is just to say that sometimes it's hard to guess. I would say that it's low probability that, you know, regulation like this will be passed. But let's say if it get passed, right, then it will have some tangible impact to the business. But how big it is, we can't generalize. We just need to look at each companies and then look at what are their offerings that is having this kind of behavior that needs to be stopped, right? And then from there, only we can try to like estimate. And sometimes it's also like not so easy one because the whole thing is not static one, right? For example, like let's say Amazon, they can't prioritize their Amazon Basics products, right? Then what can they do, right? So they will also have work around and then they will change their strategy. Hence, it is very hard, sometimes very hard to predict like would it hurt their business or not. So that's the thing. So I think not so easy. Any questions or anything that you guys want to share on this? Any insights when it comes to antitrust? Please share. Okay, if not, let's look at some other things that I pull out. So this one is Amazon news. So I just saw that this news that they are closing their warehouse. Actually, if you follow their earning costs, right? I think in the 2 quarters ago, they said that, okay, we have this overcapacity problem. And then I think the last quarter, they mentioned that they are reducing their workers by about 100,000. So I think it drops the number of workers also like quite high numbers, right? I think it's around like 1.6 millions, and then drop by 100,000 is also quite big, you know. So they are not doing retrenchment because their attrition rate is quite high. So as long as people leave and they don't hire back, right, it will naturally drop, right? So there's a lot of they are really reducing their number of workforce, right? And then this news is talking about that they are closing down their warehouse. So what happened is that in 2020 and 2021, they are like, I think, doubling their warehouses capacity, right? Just because of all this e-commerce boom, because of the COVID and so on. And then starting this year, they say that there's overcapacity. Then very soon now we are seeing that they are closing down and delaying opening up of all these warehouses. So, and then this is the map that they provided and with the list of the warehouses that is affected. So I'm just sharing this news because I think just to give you some examples on like the way all these companies managing versus, you know, like the old companies, right? Now, companies like Amazon, they are making use of all the, you know, the data, the big data that they have, right? So they can really anticipate all these sales in advance, right? So what happens is that once they have all this data, they already know that the growth will be slowing down, right? So they don't have to wait until all this impact, then only they cut down their capacity, right? So all this, they already know like 6 months ahead, and then they already like they call it the right sizing or downsizing their capacity to help controlling the cost, right? So, and they are quite agile in terms of doing it, right? So they are not waiting, straight away cut down. And hence, I think this is, to me, although on the macro ends, it doesn't look good, right? Because when growth slow down, I think most companies will be affected. But in terms of the management, I really need to give credit to them is that they are not waiting now. So very fast, they cut down. Warehouses need to close down, they close down. Need to delay, they just do it in a fast way, right? So I think that alone should be something that positive to me now, because when you compare Amazon business, they are in the e-commerce, but e-commerce still in the commerce, right? So they are still competing with other companies. There are some companies in the commerce which might not have data that is as advanced as Amazon, right? So these are the companies that even if they have overcapacity problem, they might not react in such a fast way. So these are, you know, volatile period like this where you need to like increase your capacity very fast, and then you need to reduce it very fast. This one, I mean, all the data that you can make use of to inform your decisions on how much capex to spend, right? I think you can see that Amazon is reacting very fast. So on this alone, I would say that I'm bullish on the management. But on the macro side is looks quite bad. So, you know, to the extent that they need to close down so many warehouses, right? Doesn't look good.
Anyone on the unionization effort, whether or not it's just a preemptive measure to kill unionization efforts before they actually start?
Actually, that one I didn't follow closely. It's just that I think there's this comment given by Andy Jassy during the, you know, the recode or code interview, right? So it seems that Andy Jassy isn't like, I think I just read the headlines because I don't think they already published the entire interview. But once they publish, for sure I will watch and I will share, right? But I think he seems like, I think just based on the headline, he isn't accepting the result of the votes. So I think they are still trying hard to like just not recognizing these kind of things now. So of course, companies like this, right? I mean, if you are them, you will also like don't like the unionization, and then you will do something behind the scene, right? For example, like all this warehouse closing, right? I think they will use these kind of things to say, okay, if you do too much of it, right, you come and negotiate too much and go and form all this union, right? Then what we can do is we will have to just like close it down, right? So I think just from this angle alone, I think I don't expect huge traction, at least based on what Amazon can do. Like, it's not static, right? So on the union side, they can do something, they do the vote, and then they try to have this wave towards unionizations, right? But on the companies, they are not stopping, right? They can also do something to encourage and try to shift it around, right? And I think in this sense, I think the leverage, I think Amazon will still have some leverage to block it. So at least this is my own view. I don't have much data to share on this stuff, but I don't expect this one will become a big wave, no. Because on the automation side, they can still do a lot of things to reduce the reliance on people's and on their employees. But let's see on the union side, things keep changing, right? If there's any news, hope that typical Singaporean you can also share, right? We can always follow this. Okay, let's move on. I think this one quite interesting. I know some of you also like quite bullish on Palantir, and then I think whenever Alex Karp giving speech, sometimes quite interesting to hear about. Especially now we are on a like geopolitics situation isn't that stable, right? I think whatever Alex Karp shared also will be interesting. I think this is an interview that 45 minutes. I watched all of them, so I think it's quite interesting. And also, of course, we have Stanley Druckenmiller, right? So this is the legendary. I don't know whether we should call him like investor or traders, right? So basically, he worked for George Soros funds, and then his returns is like very impressive one, and he has very interesting take when it comes to macro. So I think this interview is quite interesting also. But they talk a lot on the Palantir side, on geopolitics, but I just want to bring you guys to the attention of what Stanley Druckenmiller said. So basically, just to quote the headline, right, the main point, right, he said that there's high probability that stock market will be flat for 10 years. And then the argument is that since when he was managing the funds, right, that was the globalizations. The entire world basically moved towards globalizations when China joined the World Trade, and then basically they provide a huge number of low cost labor to the entire markets, right? So the globalization actually suppress the inflation by providing all this low cost labor, and then now it's just like from now on it seems like now we're moving to the other direction, which is every nation's like anti-globalization become a trend, right? So, big nations like US, Europe, and China, they are all moving towards self-sufficiency, right? So this one always is like anti-globalizations, and it is, from inflation side, when everyone have to do their own things, right? Imagine that China need to design their own chip, and they need to manufacturing their own chip instead of just relying on Taiwan, right? Then every countries also do the same, right? It is from cost perspective, it doesn't look good, right? Even US side, they have to build their own chip, right? So you push up the cost, and all these costs, right, will just like trickling down to the end consumers. So when this happens, right, when you have inflation, and the inflation, because of all these things continue, right, inflation is not cooling down, then what happened is that I think from the monetary perspective, they have no choice but to tighten it, and they might not be able to ease it for the foreseeable futures. And this one is always bad from stock market perspective. So basically, this is some macro commentaries. So basically, yeah, I think I have summarized the points already. Just want to see around anyone have any takeaway or any questions with regards to commentary like this. We can always discuss in more details. Anyone watch this? No response means haven't watched, but it's okay. Quite interesting one. You can watch if you are interested. I think Stanley Druckenmiller is always interesting to listen. Yeah, very, very engaging comments sometimes. Okay, I think the last one, I just want to run some advertisement. This is the trust banks. I don't know whether I should run all these advertisements also. They are not paying me, right? So this is just some referral things. My friend texted me to say, okay, why not you sign out this? I was like, oh, come on. So again, like how much can I get from it, right? The person who refer you isn't getting much. Let's say if now I refer you this, right, only get $10 voucher. But if you sign up, right, then you will get the $10 as well. And after you do the first spending, right, you will get $25 voucher. So in total, $35 voucher. So at the $35, I think that one is quite attractive. But let's say for whoever, like you are referring your friends, you only get $10. Isn't that much. But the good thing is that I already tried to install it. I think the process is quite smooth. Like you have your SingPass, right? You just link it, and then it's quite fast. I think it's done like within like 5 to 10 minutes. And then I just link it to my Grab account, and then I just do a top up to Grab. I think that one is considered like a spending, right? So that one alone already get the $25. So very fast. Like I think 10 minutes work. So what happened is that you will have one app sitting in, on your phone. And then basically in terms of function, I don't think there isn't much function, because basically it's just like a digital bank. And then basically you can use it for your, let's say like your Apple Pay, like a digital wallet kind of thing stuff. So it's not like they have a lot of functions, right? But I think when it comes to the interest rate, I think interest rate is also quite attractive. For sure, it's higher than, you know, like the traditional banks. Let's say if you already exceeded the threshold and you are not able to get it, I think it's like something like 1%, or I forgot how much already. But I would say it's more attractive than traditional like current bank account by a lot now. Like even for Sing Life, I think it's also like, I don't know, 1% something. But that one's subject to a cap, right? So this one, I think the cap is higher. I remember it's like 50,000. So basically this is the code that you can, I think once you sign up, right, you can generate this code for yourself, and you have the referral code, and you can refer to your friends, right? This is mine. Later I will share in the group. So if you want to support me and earn your $35 voucher, then yeah, this is the advertisements. Okay, that's on this. Any questions so far on any topics that you want to cover? If not, we'll just move on to the Q&A. Okay, if not, then we go to Q&A. The first question from Jay: how do you buy stocks in the long run, DCA periodically, monthly or weekly? I'll go first. I think my money put into brokerage account is every month. So this one should be consistent unless there's specific situations with my own financials. So I'll do it on a monthly basis. But when it comes to buy, sometimes depends on the market, sometimes depends on my mood. But usually I would say 1 to 2 purchases per month. So it's kind of like just smooth up the purchase, right? I don't want to like just die have to do one transaction per month. Then I cannot do anything for the upcoming 3 or 4 months, 4 weeks, right? So I'll just do one purchase, maybe 2 weeks later, I'll maybe do another purchase. Hence, it's like, you know, every 2 weeks I can buy like $1,000 or $2,000 of stocks. So that's me. I don't think this is very important in a sense of like whether 1 month, you do it one monthly or do it weekly. I don't think it's that important stuff, because over the long run, you just buy, you know, every week, or you buy every month. I think it shouldn't be that big of a difference one. But I'm curious to hear like anyone else who are, you know, doing DCA. Let's say if you can share how frequent you do your trades. Also interested to hear. I know you're here, right? You want to comment, because I know you're buying REITs, right? So do you buy like on a routine basis, or it's more like just ad hoc basis? Like sometimes you buy, sometimes you stop. Just curious to hear.
For me, no, I don't DCA. So I buy when I feel that yeah, it is attractive lah. Yeah.
So let's say your one purchase, right? How big is the amount? Like, because you don't do it that frequent, right? Could it be like 10, 20,000 in one go?
Yeah, it can be around, yeah, that amount. Yeah. Okay, it depends lah. It depends, yeah. But yeah, I'm more of a lump sum guy. It hasn't always been great lah. Like for example, I lump sum quite a bit into DBS before the crash of 2020. So you can imagine lah. Yeah. So I think from, if I remember correctly, at it was $25 plus before the COVID crash, and it went out all the way to $16. Yeah, so yeah, just to let you guys know, hasn't always been a smooth ride. Yeah, but I'm a lump sum guy lah. Yeah, I don't really DCA. But I would DCA if I feel that it looks attractive, but maybe the bottom is still far, then yeah, I would consider DCAing under those circumstances. But if I feel that something is expensive, then I won't DCA, even though I like the company. Yeah.
Okay.
And if you ask me, I think REIT yields now don't really look that attractive. And I have some REITs that I'm holding, so yeah, I'm quite apprehensive lah.
Got it. Thanks a lot. Yeah, I think that's the things, right? All this is very personal, right? You see, I'm doing monthly DCA. I think the monthly DCA sounds very common, right? If you ask around, people say, just DCA, simple, right? But actually, if you ask around, I believe actually, I would say majority of people don't really do DCA one, meaning that they will just buy when they want to buy. It's more not like consistently every month buy same kind of amount. I think those who really DCA, I would say, are mostly those who make use of some like end hours where you only set it one time and then let it just run automatically, right? And then that one is easier to, because you only set it one time, right? So it will DCA for you. But let's say own self DCA, I think this is I believe it is not super common. Yeah, even for myself, I won't say that I'm like every month constant amount. Sometimes the market looks a bit higher, then I also procrastinate a bit and then just want to on hold a bit, and then maybe when it drops, I can buy a little bit more, right? Yeah, so this one really depends on individual one. Okay, what is your view on the future of Bitcoin? Will countries ban it, like imposing high taxes for trading Bitcoin or banning mining? For Bitcoin questions, yeah, YCX is not here. Usually Bitcoin, we have to ask him now. But for me, right, I would say that actually Bitcoin, the interesting part is that when it was trading at 67,000 versus now trading at 20,000, how Bitcoin work is really still the same. Bitcoin will always be, like controversial, and then some countries will ban it, some will remove the ban, and so on. And then the regulation of Bitcoin also is not static; it's keep on changing one. So I'll say that if you are already open up to the idea to say, okay, this could be an asset class that you want to own, right? Then you just have to accept the entire package, and the entire package will include whether all these countries, in terms of regulation, what they plan to do on it now. But the thing is, it's very, very hard to really ban Bitcoin entirely. Some countries, they will say, okay, it's okay to own, but okay to trade, but not okay to use it as a payment. Some countries will say everything to do with Bitcoin cannot be done. You cannot own it, or so on. So even when we talk about what can be do or cannot be do, you also need to ask like what are the specific things that they ban on, right? But at least because when I read this question, I also look through like some Wikipedia to see what are the summary of situation with Bitcoin, right? So if you look at the interesting part is that if you look at US, right, actually it is legal, So US is legal, and then I think the big economies like even Singapore also is legal, right? So only China it is illegal. Then but China illegal, Hong Kong is legal, Then you see it's a mix now. You see some legal, some illegal, some ban the payment. For Malaysia is legal, Singapore is legal, and so on, right? I think so. This is the things, right? I think some of these countries they see this as something that like a positive development, and then they support it, and we can set up the ecosystem on top of all this crypto. I think that's good, right? Providing that you believe like all this like Bitcoin is the future, and maybe not just Bitcoin or maybe like the entire crypto infrastructure, these are the futures, right? Then I think if you believe this is a good thing, then you can, can get some exposure. But let's say if you don't believe it, then just stay away. I think this is also fine, right? But in terms of how it works, when it comes to regulations, yes, it changed over time, but it doesn't change drastically within a short period of time. It's not like US suddenly ban and unban for a couple of times in the past few years, right? So I think in terms of adoptions, there are countries that they are favoring this kind of development. So you can get some assurance on that. But of course, there are countries like China that will say, okay, please don't do this. This is all we need to make sure that renminbi is the only choice, right? In terms of currency and payment. So yeah, so that's the attitude, sir. But in terms of the future regulations, I would say I'm not concerned, I would say. Yeah. I think that's on from my side. Anyone want to comment on this? Let's say if you have any insight on what's upcoming for the regulation, or want to comment on the on Bitcoin or crypto regulations, also interested to hear. Okay, if not, let's move on. How to invest during high inflationary time? I don't have a good answer on this there, because when I invest, right, I don't really pay attention to say, oh, now it's inflationary, hence I should buy inflationary proof stocks, right? So I would rather buy companies that will do well regardless of whether it is inflationary or deflationary. Because if you look at now, it is inflationary. I don't know how long this inflation will last, What if next year, then we are talking about deflation, and then we talk about recession, then should I change my strategy again? So this one, it will always become like a thematic kind of investment. Hence, I'm not paying too much attention. Because if you do this kind of thing, you say, okay, inflationary time, I should invest in company or sector ABC, right? Then the next thing is that you keep on asking yourself, okay, how long will current inflation environment last, right? Then it's another set of questions. And then what are the forward indicators that will point to okay, this inflationary period will come to an end soon, right? So it becomes there's a lot of work behind the work, and a lot of other questions to help you make this kind of informed decisions in order for you to, outperforms, right? So I'm not saying that this one is bad. If you ask portfolio managers, those who can steer around different sectors to take advantage of this, and maybe even steer around different companies to really take advantage of the trend, right? Of course, they are doing that in order to outperform on a short-term basis. I think if you are portfolio managers, you are expected to do these kind of things, and you are expected to know what kind of indicators to watch for in order to just steer away before others, right? Because it is always kind of a medium-term kind of positioning, right? So that's why I myself, I don't do that. I don't know, let's say in the group, I don't know whether others are doing this, right? Then let's say if we just look at, if we don't generalize this, right? I would say that for the companies that you are investing, if you're doing individual companies, right, stock picks, right, then if you just look at the income statement, just try to understand what are their inputs, right? I think you will have some idea on whether they are inflationary proof. So companies, let's say manufacturing companies, I don't think is good, because for now, the input cost is getting high, right? So if your input costs, material costs, getting higher and higher, doesn't look good. It hits even though you can keep the margin. Say for example, in the past, your input cost is, let's say, $80. Then you sell at 100, you pocket that $20, right? Even though, let's say now, your cost from $80 has increased to 130, but you still can sell at 150 and pocket the same $20, right? Even that is true, but because you need to buy at 130s on your input instead of 80s, right? Meaning that your capital tied up with the companies actually become higher. It will still hurt you in terms of your return on capital, because now more monies have to sit in the company in the form of inventories, in the form of like input that you haven't used, right? There's always something sitting in your possessions, right? And if that become too high, that will hurt your ROE as well. So when it comes to, I think all these like manufacturing, and then as long as you need to buy and your input costs getting higher, these are the companies that will be hurt by inflations. And actually, even if it is not commodity type of input, let's say if you are like in servicing, right? If your employee salary costs become higher and higher, now we're talking about like very hard to get people to work, right? And you basically need to jack up the salary in order to attract employees. I think this is also something that is bad for the companies now. So these are the things to look for. And then the things to look for to show to the evidence of like inflationary proof is that, you know, companies that they can just increase their price, they have pricing power. These are always good. And then also companies that have, you know, like very low incremental cost, like the marginal cost of their items is very low. For example, like software products now, like they already built their products. Then if additional buyers go and buy their products, they don't need to, you know, rebuild the product, right? Basically, they just like copy, like just license to you. Usually is you like software products these are really like it will benefit. So there might be some companies that they are like they will be fine, right? So a lot of angles to look at this. It's just that I don't have particular insights on which companies to buy that can benefit. Okay, please stop me if you have any comment. If not, I will just move on. Question to all. Anyone bought the dip during this week market declines? Wow, very specific questions during this week. I haven't bought anything, so I'll pass. Anyone want to share what companies that you have bought or anything on this? I'll just stop here to see anyone want to comment. All right, as usual, become quiet and quiet. No one want to share. So the last question, I think I answered already. Fed rate hike, the answer will be 75 basis point. Well, I think 100 basis point, this is not impossible. It's just that if this happen, right, then it looks very scary because they just need to do 100 basis point once, right? Then the market will say, wow, what if they do another 100 basis point the next round, right? So they will always extrapolate. So I don't think Federal Reserve is to the extent that they want to do this kind of crazy things. So I think I still believe they will do 75, but maybe another 2 more 75 still looks very scary, right? Because we are now talking about like 2% increase in the short rate. So it's really crazy, you know, especially for some I don't know, maybe some businesses, if they are doing this kind of like, they need a short-term borrowing, they do the daily rolling, right? Wow, it looks very scary. It will hurt some companies, like maybe even banks, you know, because there are some businesses that they really do short-term financing, but they invest long-term one. So, and this one will hurt their short-term financing, like in a serious way. That's why if this continue for another 2-3 quarters and just stay high for like extended period, right? Say for example 6 months or 1 year, right? I think the economy will be seriously impacted now. I think now I think the recession is really given already. For sure, we will get into recession. The question now is like how serious or whether it's mild recession or a steep recession. That's the questions. Okay, done all the questions now. We have like 13 participants here. You guys have any topics that you just want to like talk about? Maybe just points to some topic. We can have a short chat before we close the call.
Hi, Boon. Can you hear me?
Hi, Jay.
Hey, hi. Yeah, I have a question. Because just now you were talking about recession. So, in your view, right, with the current high and sticky inflation, do you think it is necessary for the Fed to actually bring the economy into recession to bring down this inflation? Because the current CPI number is very high. In fact, it's very far off from what the Fed wants to achieve, which is around 2%, right? So do you think they have to stay very hawkish, aggressive in their rate hikes? And also potentially, in a way, they have to bring the economy into recession just to curb this inflation. We'll be happy to hear from your side.
Oh, thanks, Jay, for the questions. I think a bit. I know that I have listened to like this all in podcast, and then David Sachs also say, a couple of them, Chamas also say the same thing, right? They always say that okay, inflation now, let's say talking about like 2 to 3%, inflation at 8%, you can't expect that by just raising it to 3 or 4%, you will able to bring down the inflations, right? I think this is the current narrative, right? But then I don't think. I think it's very hard to say how much it needs to go and then whether we need a recession to bring down. I don't know whether this is true or not, and I don't have insight whether this is true or not. But the thing is, if you look at from Federal Reserve perspective, right, they don't have like a number of tools. It's not like they can do different creative stuff just to help to cool down the inflations, right? So inflation is, like supply chain problem, like commodities. These are not the things that the Fed can work. They only have one tool, which is the interest rate. So if the inflation is high and they don't do anything, and then the inflation get haywire, and by the time the history is written, right, they already failed their job, right? So they have to do that. So they actually, I don't think they even care about like whether it needs to be higher than the inflation in order, like the statement that you just gave, right? Like it needs to be higher and then we need the recession. I don't think they even care about that. They just care about like, okay, now inflation is serious and the only tool that I have is the interest rate. Then what will you do if you are in their positions, right? Then you will just hike the rates. And after you hike the rates and you just observe the data, and if the data is cooling down, then maybe you can slow down the rate hike, and the inflation number is still sticky, then you just continue to hike. No? So it becomes like almost like a robotic kind of reaction to this whole thing about the inflations, right? But whether how high it has to go or whether we need to see recession first, then only inflation to come down, my answer is I don't know. And I don't think they know also either. Like almost like nobody knows, right? And the thing is, one thing clear from the Federal Reserve is that even though recession, if we see a recession first and inflation still high, I don't think they care about the recession. That's what they have been communicating. They will just say, we will do, basically our top priority now is inflation. Let's get the inflation done first. So let's say if there's a recession, don't expect that they will lower the interest rate. No? So I think that is also something that will be helpful for us to know. Because if you don't know about this, right, and somehow you have a wrong perception that, oh, now inflation, recession is here already, they have to cut, and you're hoping it to cut, because you say that once they cut, the stock market will be safe, right? If you make that wrong assessment and they keep on continuing to increase the rate, even though the recession is getting serious and serious, right? Then stock market keep on crashing, and you make the bad assessment. Especially if you are trading, you came in long the market in hope that they will lower the interest rate, and it doesn't happen, right? Meaning that you will screw out this entire trade. So that's why I would say maybe all this, like whether the recession you have to come first or not, I don't think that's relevant. What is relevant to us is that we need to have a right expectation on whether they will pivot or not, because they pivot or not, this one will impact the stock market immediately. And I really believe that they will stick to their gun to really at least cool down the inflation stuff. Yeah. Yes, typical Singaporean, you want to say something?
Yeah, I'm concerned about Nvidia because EVGA is leaving their business. And the reason they're leaving the business is because it seems that their gross margin for video cards are crazy small. And I saw some data showing that all of them, the AIPs gross margins are shrinking year on year, whereas the opposite is happening for Nvidia. So it looked like Nvidia's gross margin growth was due to them squeezing the supply chain. So So our business models assume that Nvidia's gross margin will grow year on year, but it looks like there's going to be a limit. And do we need to go back to the drawing board and reevaluate Nvidia, because this is the largest revenue stream for Nvidia too, gaming boards.
Yeah, I think how I look at this is that they are different business, right? So Nvidia is like they come up with the chip and then they pass it to the AIB, and then AIB will package it and then sell it to the end consumers, right? So when we talk about Nvidia, they are competing with let's say AMD, right? When it comes to GPU, but when it comes to AIB, let's say the EVGA, they are competing with others AIBs, right? Asus and so on, right? So what happened is that I think it's very different economics when you are looking at the Nvidia side, and also you are looking at the AIB side. The AIB side, I mean, I don't think they have a good margin. So basically, these are low margin kind of things. When you plot the entire supply chain of the semicons, right? I think from the chip design to chip manufacturing to chip packaging to a lot of different things, right? For what EVGA is doing is always the low margin part. I think the problem now is that the cost has been getting higher and higher. So their input costs also getting higher, right? Because, all the wafer increased, TSMC increased price. Now Nvidia have to increase price. Hence their input cost, which is the Nvidia chip, also become higher. So all this will actually hurt their economics, and they have slim margin. If you have slim margin and then now you have to increase their cost of input, I think it just doesn't make sense to continue anymore. So what happened is that they will pull up from the markets, right? And whoever remaining, right, they will become like less player, and less player means less competitions. Less competitions means that their margin could be higher. And where does this margin comes from, right? I don't think it will come from, they will eat into Nvidia side, because what happened is that they can just now be more, not to say aggressive, they can be less aggressive when it comes to their pricing, and maybe they can jack up their price knowing that now they have one less competitors, right? Ultimately, all this will pass the cost down to the consumer sides, and things will just get more expensive. So I don't think this one will hurt Nvidia just because one AIB pull out. But if you just look at the entire, like how their relationship works, right? If Nvidia do too much to screw it's something like their partners, right? Long-term wise, of course, it is not a good thing. It's not a good picture to look at. I think this one also, please go ahead.
Yeah, I don't understand why it wouldn't hurt Nvidia, because let's say there are less AIBs. Okay, now one of course won't hurt it much, but every one of these AIBs are experiencing the same problem where their gross margins are shrinking, and the largest input cost, I presume, would be Nvidia. Their cost to the customer is completely controlled by Nvidia too. The MSRP is probably benchmarked against the Founders Edition. So they have no room to play on the upward movement. So they only can negotiate with the costs. And if there's less competitors, they have I would say it's not monopoly, but over some time it will mean that Nvidia would have to lessen their gross margin when they sell to AIBs, and thus it will impact their gross margins. They will have to lower their costs when they sell to this. They have a lot of room, because their gross margin is 50-60%. So they have a lot of room to give to the AIBs. So our business models assume a growing gross margin because it has always been growing. But in this particular situation, we might need to reduce this gross margin. That's my thinking.
Yeah, I think I will agree with you on that. It's just that I think now what happened is EVGA pull out, right? I think moving forward, we need to see what's the attitude of the remaining AIB, because if this EVGA, the problem that EVGA is facing is faced by all other AIBs, right? But if they take this as an example to say, you see, the margin is so low that some of the AIB already pull out, and we ourselves also consider to pull out if Nvidia keep on squeezing us, right? So if they use this and they go and negotiate with Nvidia, then Nvidia maybe they have to either you got few choices, right? Either you just pass down more cost to the consumer and that will hurt your competitions versus AMD, right? Or you can say, I will squeeze you less and then I will just hurt my own margin and hopefully the entire ecosystem will remain intact, right? So that one will hurt NVIDIA. So there are a couple of things that they can play around. I don't know how it will proceed, but ultimately it still depends on the remaining AIB, whether this will change how they do their business, right? Because if they say, okay, even though now one pull out, but because let's say out of, I don't know how many AIBs are there, right? Let's say out of 10, one pull out, remaining 9, they still have to compete among the 9, right? So if nothing has changed drastically, things could just, just play on for another 1 year and another 1 year without drastically changing the entire landscape. Because now we are not talking about the sole partners, right? This is like a number of AIBs. One pull out, I don't think it will be something that will change things drastically, unless this one become a trend. If one pull out, then suddenly another pull out, then I will be very concerned. If it is just one, I kind of like just wait and see approach, because we really hard to say like the remaining AIBs, right? What are they doing to do about it, right? And of course, this one will increase their bargaining power, negotiation power. But it's not fair, when one side you only have NVIDIA, the other side you have like a number of AIBs, right? All the AIBs will need NVIDIA more than the NVIDIA needs the AIBs. So that's the realities now. I think this one, right, the things about all these situations, right, is quite similar if you look at Apple. Apple is also known as like keep on squeezing their partners, right? Including, all the app developers and so on, right? Say, for example, like Facebook, right? Facebook is also like kind of like one of their partners, right? Because Facebook need Apples, because in order to reach their markets, right? Imagine that now Facebook just say, oh, we don't develop apps for iOS, we just pull out, right? Something like that. So Facebook cannot pull out because they also need these users, whoever these users are, right? This iPhone user. Imagine if you are using iPhone, you can't use Facebook, then it will just hit their reach, right? Then at the same time, Apple also needs Facebook. But when it comes to like the platform owners versus the partners, right? You will see that maybe Facebook is not a good example, but you understand when I talk about Apple, when they negotiate with Foxconn and so on, these are, low margin business, right? So when they do this kind of negotiations, it's always the big ones, they are always winning, right? So they will always screw their suppliers. But the thing is, as long as suppliers, even though they get squeezed, but they are still able to get a returns, right? They will still continue to do it, right? Because regardless of how low is your profit, as long as you're profitable, do you want to kill your business? Because in terms of margin, even though it's low, but they are playing the scale, right? So some of them will still gladly take on the business if you just exit, right? So yeah, it's always not fair, I would say, when it comes to this kind of relationship. But the thing is, does all the AIB, they are able to band up together to use that power to go and squeeze back the on the NVIDIA side, right? If they're able to do that, right, I think they can always influence how NVIDIA do operate their business. But so far, if you understand the dynamics of the ecosystems, right, why the margin is so low is also because whatever that they are doing is more on the commodity. It's more commodity side of things. So meaning that let's say even like half of the AIBs, they just say, oh, we don't want to do this, right? We will just pull out. Then how much will it take for a new entrance to say, okay, now all this EVGA, they just pull out, right? Maybe some other companies will say, why not I just do it, right? I just enter this AIB business and I just take business from NVIDIA and I could be profitable. It could be a profitable business, right? Who knows, right? I think the takeaway is that whatever this AIB are doing, it might not be the very difficult kind of things to do. So if it is not too difficult, there isn't much mode, right? So they will be the one that gets squeezed. Yeah. At least that's my take now. I really don't know, like whatever that all this you say Nvidia, they are getting 50, 60% gross margin. Why all this AIB, they are not getting higher margin, right? They just need to band together. They can always squeeze Nvidia, but we are not seeing it, right? The question is why, right? There's always a why we are not seeing it. So this one has to do with the dynamic of the business, of the ecosystem. So there are some reasons behind that which I don't know the details. My answer is always that if they can do that, they're already doing that, right? So they would rather pull out. It just shows that they don't have the bargaining power when it comes to negotiation with Nvidia. Yeah. Anyway, this on the AIB. I hope that I think Nvidia will launch their 4000 series soon, right? And hope that the benchmark, the product really looks powerful and they're able to sell their products. Then we come back to the growth stage, right? Because if we just look at the recent 1 or 2 quarters, it looks super ugly. Yeah. Ugly until I don't dare to buy already.
Regarding Tesla, what is their plan actually? Are they trying to eventually, is their end game to displace, to put all the cheap car manufacturers, like the Japanese car manufacturers or the China car manufacturers out of business by pushing the price down?
I think when it comes to their long-term outlook, right? So I think Elon Musk has said that by 2030, they will be producing 20 million cars. So if you look at today's auto market, it's not like 20 million cars annual productions come from the premium markets, right? Right now, as of now, maybe it's still true for another 2 years, is that if you talk about Tesla, there's this premium feel when it comes to it, also partly because of the cost. Tesla car is not super cheap, right? So with the price, it comes with this premiumness. But when you say, when they are going to sell 20 million car a year, right? I don't think, okay, we can debate whether they are able to achieve it by 2030s, right? Let's say there could be a couple of years delay. I won't be surprised. But with the ambition of 20 millions, for sure, they can't stay at the premium, meaning that they will go down to the, the medium tier. So the medium tier, we are talking about, they will compete with Toyota, Honda. They have to go there in order to sell 20 million car a year, right? So this is the roadmap. And in order to achieve that, for sure, they can't just stop at whatever their current offering is, which is the Model 3 and Model Y. They will have to launch a cheaper car. I think the last round, when they share about this, they say, okay, we're not talking about the cheaper cars, right? I think also because they have all these supply chain problem, they just want to make sure that, let's say on Berlin's and then on the Texas, they are able to come up with, they just want to ramp their productions, meaning that the Model Y, Model 3, and also Cybertruck, they want to do this first. Let's just focus whatever is their immediate priority. And then once the queue, right, the waiting times become shorter and shorter, which we already start to see it, right? Let's say on their Chinese gigafactories, right? So I think within short period of time, let's say talking about 1 to 2 years, or for sure they will talk about the cheaper cars, cheaper variation. So that one will be the, like 2 to 5 years kind of roadmap, right? So yes, the short answer to your question is they will have to launch a cheaper tier and they will compete with Toyota, Honda, Mazda, Volkswagen, Ford. All these they will compete and with this medium to high-end tiers. Not to the extent that they will compete with the super luxury cars. I don't think they will go there because from the start, right, Tesla business model is never a super premium car. Although they always say that, oh, our car, we can accelerate in how many seconds, just try to bring in all these features that come from super sport car, right? But they will never be this super premium. From the start, their business model is towards the scale, meaning that they have to build affordable cars. In the start, it is not affordable because, to ramp up all these things, to build the infrastructure, they don't have the scale, right? So it will always be expensive. Even, let's say, before Model 3, right? When they just launched Model S, it's like almost like a super premium cars, right? But now you can see that now they are at a premium. And then once all this infrastructure on the EV, once they have the skill in terms of the mining, in terms of the input costs and so on, right? For sure, they will go down to the mass market, which is the Toyota, Honda range now. So, yeah. I hope that answers your questions. The short answer is yes, they will go there. The question is when.
Okay, got it. Thanks.
But it's always interesting
sorry,
to talk about. Yeah.
When did
Go
you
ahead.
say is his target to sell the 20 million cars?
That's 2030.
Oh, okay, got it. Thanks.
Yeah. If you do calculations, right, from let's say 1 million car in 2021 until 20 million in 2030s, right? We're talking about 9 years to compound by about 20x, right? Actually, it works out to be, I think, CAGR of about 30%. And that is, if you look at what's their growth rate, let's say in 2022 until, let's say, 2024, okay? I think they will still grow at 50% kind of range. And that is also because there's this ramping up for Berlin and Texas, right? So I think just purely these two ramping plus on the Shanghai gigafactories also, I think in terms of their annual output, still keep on increasing, you know. So I think they are able to pull out this like 50% each kind of growth for at least like 2 or 3 years. Then of course, once they hit like, let's say 3 or 4 or 5 millions kind of productions, right, the growth percentage will come down. But the annual production rate, I think, will still continue to go up now if you look at the absolute numbers. So I think this is, I mean, if you ask those people who are very bullish on the companies, right, they are mainly looking at this, you know, like the 50% growth for 2 or 3 years. Even if it is 2 to 3 years, right, you multiply by 4, that's about like what, 12 quarters of high growth numbers, right? So as soon as they keep on executing this, and on the margin side, if they're able to grow, it will help out in the margin, because, you know, the fixed cost there are fixed costs that can shed across number of cars that they sold, right? So it will look good on the margin side also, and you added up these two together, I would say that the net income will increase at it's still scaling, and it will increase drastically. I won't be surprised to see, let's say, their earning per share to increase by, let's say, 3, 4, 5, 6 times within 2 to 3 years times, you know. So that's something to look forward to for those who care about the financial end of things.
Okay, thanks. Roughly, do you know how many cars they delivered so far? Like for last year versus this year?
I think the recent quarter, it dropped a lot because Chinese, the Shanghai Gigafactory shut down, right? So I think, offhand, I don't remember the exact, I think what, 200, let's say 260 or 270,000 car in one quarter. So you analyze it, that is like 1 million. It's not super impressive. It's because of the Giga Shanghai. But if you look at the coming one, right, which will come out soon, I would say, let's say in 2 weeks' time, they will disclose the Q3 numbers, right? These numbers should be, you know, like, I don't know, I guess will be in the range of 340,000 kind of range, right? So if you analyze it, it also become like what, times 4, 1.3, 1.4 million car production. So
Okay.
that is, that's the run rate that they are running now. And, you know, Giga Shanghai, they also just do some upgrading, and then that one already seen some increase in the production. Because there's some disclosure in terms of their monthly output, right? So we can see that already. So this is no longer a guessing work, you know. At the same time, I think Giga Berlin and Giga Texas, they're still early in their ramping. So, but still we see like gradual increase in their productions, right? So it doesn't matter, their annual run rate is like 1.2 or 1.3 millions, right? But I think in the short period of time, they will reach 1.5 and 2 millions. This is like talking about whatever gigafactories that they are having. We're not even talking about the new gigafactories that they are building, right? So you can safely say that they are already at what, 1.5 or 2 millions kind of production, not too far in the future, you know. So when they are, you know, like just 1 or 2 years back, right, when they are still talking about like only Giga Shanghai, there's still question mark on whether they are able to ramp up. There's a lot of question mark. But now if you just look at like they already found the formula. Now it's just execute on the formula. But when they are executing this, there's all these supply chain problem that kind of like putting some brakes into their growth. So once they sort out all this, right, and given time, all this can be sorted out, right, I think we will see a good runway in terms of the ramping. So I'm not concerned on that now. So that's on their progress in terms of their production. But let's see, I think the commodity is very ambitious when it comes to very exciting to look at the numbers that they're going to report now. Always just before the close of the quarter, you will see that, wow, even the stock price also looks a bit exciting now. If you just compare, let's say, like Tesla share price movement in the past recent week or recent months, right? Compare against, let's say, QQQ, right? I think they still outperform also because of all this good news. It's totally opposite on what happened during last quarter. Last quarter is like, oh, everyone worry. We don't know how much Giga Shanghai, what will be the impact. And yes, the results is really worse compared to Q1 for sure, right? Because of the shutdown, right? And it's just that the share price didn't drop as much because people price in, like there's this serious concern on how much it will drop, right? But it turned out that the result is better than expected. So that one gives a bit of relief. And now all this, they already kind of like building up the expectation on Q3 number will looks good. So now the question is, could they beat the high expectation or not? If the result is better but doesn't beat the expectation, then okay, share price also can drop, right? So it's always the actual versus expectations. Yeah, but to answer your question is yes, I think they will have some good result, which is in the range of 330 or maybe 340,000. If you just look around Twitter, there are a lot of all this expectation one. This entire Tesla community, they are very, very super aggressive and then super exciting when it comes to these kind of things, right? Or play on all this guessing game, how many everyone will come up with their own estimation and then see who's more accurate. It's like playing game like that. Quite interesting.
Yeah. Actually, I also like to, have a rough idea, Yeah, okay, thanks.
Thank you for the question. Any other topics, any questions that you guys want to talk about? If not, we close the call. Sorry, that 12 o'clock. Okay, if not, we will close here. Thanks a lot for all you guys that dial in. Today we have 11 people here, not bad. Some interesting conversations. Thanks a lot to Jay and of course to Mr. A here. You when you join, it's always engaging. A lot of questions come from you. Thanks a lot for all the questions.
Thanks for answering.
All right, then till next week. All right, see you guys. Bye.
Bye.